Most people believe markets move because of headlines. They don't. Markets move when systems are forced to adjust, quietly at first, long before the headlines explain why. And today, several systems are adjusting at the same time. Over the last 48 hours, currencies, banks, governments, and industrial capital have all been sending signals that don't look dramatic on their own, but together tell a much deeper story. A story about pressure building beneath the surface of the global economy. That's what we track here at Money Signal. Not opinions, not politics, just the pressure points where money, production, and liquidity are being forced to reorganize. If this kind of analysis helps you see how the world is actually moving, not just what prices did today, take a moment to subscribe. This channel isn't about reacting, it's about understanding. Let's start where every system eventually feels stress: money and liquidity. For most of the past year, the dominant narrative was that the US dollar was entering a structural decline. Slower US growth, future rate cuts, and capital rotating toward other regions was supposed to weaken it. That assumption is now being challenged. According to Reuters on January 15th, the expected great dollar reversal simply hasn't happened. The dollar remains firm, not because of speculation, but because the US economy continues to grow faster than most developed economies, while offering higher yields at the same time. This matters because currency strength is not just a financial detail. It determines where capital feels safest earning a return. As long as the United States offers stronger growth and relatively attractive yields, global capital has little incentive to move elsewhere. When that happens, pressure builds globally. Emerging markets face tighter financial conditions. Export-driven economies struggle with currency mismatches. Trade flows adjust around a dollar that refuses to weaken. In simple terms, when the dollar stays strong longer than expected, the rest of the world has to work harder just to stay balanced. That pressure doesn't stop at currencies. It flows directly into financial institutions. On January 14th and 15th, Wall Street reacted negatively to mixed earnings from major US banks. As reported by Reuters, the issue wasn't collapse or panic. It was uncertainty. Some banks showed resilience in consumer activity and lending. Others revealed early signs of credit stress and margin compression. At the same time, recent economic data failed to give markets a clear signal on when interest rates might actually come down. This creates a dangerous middle zone. Rates are high enough to stress parts of the system, but growth is still strong enough to delay relief. In this environment, banks don't break. They become cautious. Credit standards tighten quietly. Lending slows incrementally. Liquidity thins at the edges. This is how financial stress usually begins, not with panic, but with restraint. While financial markets recalibrate, production systems, especially in Europe, are sending a different kind of signal. Germany, Europe's industrial engine, officially exited recession in 2025. After nearly 3 years of stagnation, Reuters reported on January 15th that this recovery was driven mainly by government spending and household consumption. However, the structural issue remains unresolved. Exports and private investment are still weak. This matters because Germany does not grow by consuming internally. It grows by selling to the world. When domestic stimulus carries the economy while exports lag, the recovery becomes fragile. Any external shock, tighter global liquidity, weaker demand from China, or a stronger dollar can quickly reverse momentum. What we're seeing is a European recovery that exists, but isn't yet self-sustaining. Now shift your focus forward, toward where capital is being pulled rather than pushed. Another signal running quietly beneath. Today's news is the continued concentration of investment in artificial intelligence and semiconductors. Reuters highlighted renewed investor focus on companies like TSMC and the broader chip ecosystem. This isn't hype, it's capital allocation. Semiconductor manufacturing requires massive investment, long timelines, geopolitical stability, and government support. As money flows into this sector, it is being redirected away from traditional manufacturing, emerging markets, and even parts of Europe. At the same time, governments are tying chip production to national security. forcing companies to rethink supply chains, locations and trade relationships. Capital is becoming less global and more strategic. When you connect these signals, the picture becomes clear. The global system is under pressure because capital is clustering rather than circulating. Monetary policy remains restrictive longer than expected. Europe's recovery lacks export strength. Banks are tightening quietly, not collapsing loudly. And investment is being funneled into narrow, strategic sectors rather than broad economic growth. This is not a crisis signal. It's an adjustment signal. But adjustments always have consequences. If the dollar remains strong, global trade slows at the margins. If rates stay higher for longer, liquidity continues to thin. If Europe fails to revive exports, fiscal strain increases. And if capital continues concentrating in strategic technologies, other sectors will struggle for investment. Money signal doesn't predict headlines. It tracks pressure. And today's pressure tells us something very important. The world is not breaking. It is being forced to reorganize. And reorganization is where volatility, opportunity, and risk are born. If you want to keep tracking where the pressure is building before it becomes obvious, subscribe, share this analysis, and stay with us. We'll keep following the money.